There's a sweet spot in retirement for tapping your traditional IRA. Miss it, and you could end up in multiple tax traps, realizing tens of thousands more in taxes than you need to. In today's video, we're going to be talking about when to use your traditional IRA and, more importantly, when not to use it. This video is part of a three-part series we're doing on the three tax buckets in retirement. In our last video, we tackled the taxable bucket. And if you missed that one, I'll link to it in the description below. Today, we're turning to what is often a retiree's largest account, the tax-deferred bucket. This includes traditional IRAs, traditional 401ks, and similar account types. For many people, it ends up being the biggest pool of retirement money for a few reasons. First, you get a tax break when you contribute while working. Second, employer matches typically go here as well, and it often offers the largest contribution limits of all account types. But here's the catch. While this might be your largest bucket, it's also most likely one of the biggest tax headaches you have in retirement as well. And there are three big reasons why. Reason number one, it's taxed at some of the highest rates. Withdrawals here are taxed at ordinary income rates, often some of the highest rates you'll see in retirement outside of interest or short-term capital gains that can see a 3.8% surtax called the net investment income tax at higher income levels. Even more importantly, IRA withdrawals don't just create tax singularly. They can also make other income taxed more heavily as well. This comes back to a concept in tax planning called income stacking, which defines the order in which different types of income are taxed. Ordinary income comes in first, and then capital gains and dividends stack on top of that. So if you just take out a moderate amount from your IRA, you could unintentionally push capital gains or dividends into a higher tax bracket here as well. We'll talk more about this later. Reason number two, required minimum distributions or RMDs. At some point, the IRS is going to force you to take money out of your accounts, whether you need to or not, currently starting at age 73 or 75, depending on your birth year. Now, the RMD withdrawal rate might start at about 4%, but it doesn't stay there. By your mid-90s, it can get into the double digits. We've talked before about a phenomenon called RMD creep. Even after you start taking RMDs, your portfolio often grows through those RMDs. The RMD percentage as well increases each and every year. On the screen, you'll see a simulation of five $1 million portfolios growing at a moderately conservative 6% return with 10% standard deviation. The dotted line on the screen shows RMDs on a static $1 million portfolio. But as we can see from the simulated portfolios, the growth in RMDs means your required minimum distributions can surge past six figures annually, often peaking in your late 80s or your early 90s. And here's the problem. In tax planning, forced income is your enemy. Once you lose control over when and how you take your income, you lose one of the most powerful levers in retirement tax strategy. That's exactly the trap RMD creep can create. Reason number three, the tax bill doesn't go away. Even though these accounts are tax deferred, the clock is always ticking. It's not a question of if the money will be taxed, but rather when. We've already talked about this on one side with RMDs, but there's another important distinction from taxable accounts here as well. In a taxable account, if you hold onto appreciated assets until you pass away, your heirs can often receive a step up in basis, effectively wiping out those embedded gains. That benefit does not exist for tax deferred accounts. Instead, whatever is left in your IRA or 401k when you pass away is often just passing along a bigger tax liability to the next generation. And recent rule changes have made this even more of a challenge. Under the Secure Act's 10-year rule, most non-spouse heirs have just a decade to fully empty the account, and in many cases, they must take required withdrawals each of those 10 years. This ends up being a fairly big deal. If your child inherits a $500,000 IRA and tries to spread it evenly over those 10 years, they're looking at $50,000 plus in taxable income on top of their own earnings. If they're in their peak career years, that inheritance could be taxed some of the highest marginal rates. Now, just because tax-deferred accounts can create planning headaches doesn't mean that you should avoid them while working, however. For most people, sheltering a significant portion of their savings in these type of accounts is often optimal. But once you enter retirement, controlling this bucket becomes extremely critical. These issues aren't just one-year problems, they're multi-decade, often compounding problems, and they require a multi-year strategy. That's where a forward-looking tax plan is a must. This means taking stock of your accounts and your goals early in retirement, and then projecting out how those balances and withdrawals will play out over time. The goal isn't to minimize taxes in a given year, it's to minimize taxes over the rest of your life. I often see new retirees fall into a common mistaken pattern. They start by drawing only from their taxable accounts in early years, enjoying really low capital gain rates, and in some cases, almost no tax bill at all. This feels fantastic, especially after decades of paying high taxes while working. But this is usually a short lived window. While they're spending from their taxable accounts, their IRAs are quietly compounding, untouched and untaxed. Once the taxable money runs out, they switch to their IRA and their tax bill jumps overnight. Add RMDs later in life on top of this, and taxes generally continue to climb each and every year until the end of their life. You end up with a tax chart that looks like a ski slope in reverse, low at first and then relentlessly uphill. The real problem here, we live in a progressive tax system where higher income gets taxed at higher rates. That means the most efficient drawdown strategy isn't one with really low tax years followed by really high tax years. It's one that spreads taxable income out more evenly across your entire retirement, smoothing out those spikes so you can pay the lowest rates possible over your lifetime. So let's start with a simple framework, one you can adapt once your forward-looking tax plan tells you where the real pressure points are. Scenario number one, RMDs are a big problem in your situation. If your projections show that RMDs will balloon over time, waiting isn't a strategy, it's a trap. Withdrawals alone won't solve this. You need to proactively reduce the size of your account, and that's where Roth conversions come in. If you also have a taxable account, the game plan is relatively straightforward here. Live on your taxable account first, as well as use it to pay the tax bill for Roth conversions. Why? Because spending from your taxable account frees up lower ordinary income brackets, giving you room to convert IRA dollars to Roth at very small rates. It's a two birds, one stone type of move. You fund your lifestyle and create tax space for strategic conversions. If you don't have a taxable account, or once it becomes depleted, then the sequence shifts. Pull the income you need from your IRA or 401k, then layer conversions on top of that to continue chipping away at those future RMDs. If you're married in 2025, you have over $125,000 of room in the 12% bracket and over $235,000 of room in the 22% bracket. That's a lot of room for most retirees to combine withdrawals and conversions without crossing into some painful tax territory. The end goal here, whether through withdrawals, conversions, or both, is to get your tax-deferred balance to a size that you have control over. Scenario number two, RMDs won't be a big issue. If your forward-looking tax plan shows that RMDs stay quite modest, then you can take a more balanced three-pronged approach, often blending withdrawals from each bucket each year. In fact, you may arrive at this approach after a few years of modest conversions. The sequence in this case is this. Fill your standard deduction and lower tax brackets with IRA withdrawals, paying anywhere from 0 to 12% on those dollars. Pull the next layer of income from your taxable account, ideally in the form of long-term capital gains tax at 0 to 15%. Then use Roth for any larger irregular needs without triggering higher tax brackets. The beauty of this approach is that you never find yourself in a tax bracket above the 12 to 15% range. That means you're keeping taxes consistently low across retirement rather than having some years with almost no tax bill and other years with those painful spikes. Next, we talk about the cleanup zone for Roth conversions. For retirees who need to perform Roth conversions, there's usually a very specific window where the math works best, what I'll call the cleanup zone. Let's say you retire at age 62. Now, if you plan to use ACA marketplace insurance and you're trying to qualify for subsidies, this window is a bit tricky. We'll talk about this in another video. Your income needs to stay low, leaving little to no room for Roth conversions. But if you're on COBRA or another form of coverage where income doesn't impact premiums, your cleanup zone can open up much sooner, really as soon as you retire here. For most retirees, the 5 years between ages 65 and 70, especially if you're delaying Social Security, tend to be the sweet spot. Why? Well, with delaying Social Security, you can end up pulling more IRA dollars into Roth without triggering extra taxation on Social Security benefits. You're reducing IRA balances before RMDs start here as well. There may still be some room to convert after RMDs begin, but it's quite a bit harder. That's because you must take your RMD first and any conversion stack on top of that income, which often pushes those conversion dollars into those higher tax brackets. Now, one question we hear a lot, how far down should I bring my IRA balance before RMDs start so they're much more manageable? Now, there's no one-size-fits-all number here. It really depends on your income sources and how much of a tax issue you're trying to solve. Here's an example. Let's say that you have a modest pension and your forward-looking tax plan shows you can only take about $25,000 a year from your IRA without triggering some of those higher tax spikes due to things like the Social Security tax torpedo. Well, if we reverse engineer this, the first RMD at age 75 is roughly 4% of the balance. To have that first RMD be $25,000, your IRA would need to be around $615,000. That gives you a target range of about $400,000 to $750,000 depending on your portfolio allocation. Let's say you have an all-stock IRA. Well, you want to aim towards the lower end because RMDs are likely to grow more aggressively over time, doubling or tripling as you age. All bond IRA, well, you can lean toward the higher end because RMDs will generally stay closer to the starting level because the account doesn't grow as quickly. In past videos, we've shown Monte Carlo simulations illustrating this RMD creep. With a stock-heavy allocation, your RMDs can snowball year after year, growing to 2 to 4 times as large as the initial withdrawal. With a more conservative allocation, they often remain much more stable, which is why you can start with a larger balance without running into runaway RMD growth. We've talked a lot about Roth conversions in isolation up to this point, but now let's try to tie this all into a more realistic example. Let's say we have a couple in 2025, both age 65 or older. They're living off their taxable account for now, selling some stocks and bonds that generate $25,000 in long-term capital gains and $10,000 in taxable interest. Here's their tax picture before any Roth conversions. We can see over $100,000 of room in the 0 to 12% ordinary income brackets, prime space for low-cost conversions. Push conversions beyond that, and you start triggering avoidable tax traps. In red, we see the capital gain bump zone, where capital gains jump from 0 to 15%, creating a 27% marginal tax hump. That's what I talked about earlier when I talked about that income stacking idea, where you can have ordinary income that pushes those capital gains into being taxed at higher rates, creating this tax trap. Then we see shortly after that, the phase out of the senior bonus deduction begins. For retirees with massive RMD problems later on, more aggressive conversions might be needed in this situation. But for most, just a few years of $100,000 plus conversions in this range will solve a lot of long-term tax pressure without triggering those traps. For retirees who are charitably inclined, one of the most powerful tools that you can use after age 70 and a half is a QCD, qualified charitable distribution. A QCD lets you give directly from your IRA to a qualified charity up to $105,000 per person in 2025, but this is indexed for inflation. The beauty of a QCD, it's an above-the-line deduction, meaning there's no need to itemize deductions. It counts towards your RMD but doesn't show up on your taxable income. The money never passes through your hands. It must go directly to a charity. Strategically, QCDs can reduce or even eliminate the need for certain Roth conversions. For instance, if you plan to give $10,000 a year to charity in retirement, you can work that into that IRA balance target that we discussed earlier. The result will be that you can leave a higher IRA balance because you can QCD some of that money later on. You don't need to fix the problem purely from Roth conversions. Now, once Roth conversions are done and your IRA balance is in a more manageable range, it's all about an ongoing withdrawal strategy. Here's an example of a retired couple over the age of 65 with $60,000 in Social Security benefits and $10,000 in dividends. Looking at their tax map, you'll see in purple the Social Security tax torpedo zone. In red, you'll see that capital gain bump zone we just talked about. And then you see the phase out of the senior bonus deduction in green. IRMA thresholds are marked with dotted lines. A pretty optimal withdrawal sequence would be something that looks like this. Fill the standard deduction with IRA withdrawals, leaving these taxed at 0%, which is a no-brainer. Fill in the next layer with a mix of IRA or taxable withdrawals depending on your balances and overall situation. Yes, some of these might fall into that tax torpedo, but if you couldn't convert at cheaper rates earlier in retirement, you end up taking that tax hit here, but doing it strategically. Use Roth for the rest, especially to avoid the nastier tax traps later in retirement. In this case, you could generate over $140,000 of total income, including Social Security and dividends, before needing to touch your Roth. That's why this split withdrawal approach can be so powerful. It keeps you flexible, tax efficient, and in control each and every year. Before we wrap up, though, I want to leave you with one more way to keep your IRA under control, not through withdrawals or conversions, but through how you invest. We've talked in past videos about something called asset location, the idea that each account type has different tax rules, so you shouldn't have the same investment mix in each account. Here's a general framework. In your Roth IRA, you want to be the most aggressive here. It has the longest time horizon for withdrawals, and withdrawals are tax-free. The growth is the most valuable in this bucket. This often means holding an all-stock portfolio in your Roth. In your taxable account, this is where interest and dividends are taxed every single year. So avoid loading it up with taxable bonds or high dividend stocks. If you hold bonds here, use shorter duration because, they generally have lower yields and you generally have a shorter withdrawal timeline here as well. Then we move on to the traditional IRA. This is often your safety bucket and cleanup account. It generally houses your value stocks, which tend to have higher dividend yields, and most of your bonds. Holding safer assets here not only matches your income needs, but it also naturally slows IRA growth, which can help with that RMD management. By structuring your investments this way, you're maximizing each account's strengths while also quietly reducing future tax headaches. Your traditional IRA can either be a predictable, controlled source of retirement income or a tax time bomb waiting to go off. The difference comes down to this: knowing your RMD risk early, using that cleanup zone for Roth conversions, coordinating withdrawals across tax buckets, and aligning your investments with each account's tax treatment. A forward-looking tax plan is what ties all of this together, helping you avoid big tax spikes and keeping your income under control. Now, if you found this video helpful, make sure you subscribe so you don't miss other videos in this series, as well as other series that we've done on a boatload of topics on retirement. And if you want to dive deeper on timing withdrawals from your taxable account, the first video in this series, you can do so by clicking the video right here. Always remember, you don't need more money, you need a better plan. I look forward to seeing you in the next video.